Welcome to this explainer. It's a pretty frustrating reality. 90% of retail traders lose money. They just get completely chopped up in market noise, while professionals somehow survive and thrive. Today, we're peeling back the curtain to reveal how the pros actually operate. As you'll see, they aren't relying on magic indicators or secret algorithms. Instead, they use a sophisticated, highly structured framework built on pure discipline and dynamic risk management. Here is our blueprint for today. We'll start with 1, the retail trap. Move into 2, the institutional framework. Discuss 3, the ATR risk protocol. Break down 4, volatility-adjusted sizing, and finish up with 5, pro-operational rules. Let's not waste any time.
Section 1. The retail trap. Myth versus reality in the markets. Let's establish the stark contrast between how retail traders and institutional desks approach the exact same market data. Think about the classic retail setup for a second. We're talking about charts completely cluttered with a spaghetti mess of indicators, combined with arbitrary, static stop losses. It's basically a recipe for getting trapped. The pro reality, though, totally different. For institutions, price, action, and volume are absolutely non-negotiable. They have to come first. Pros let market structure, things like higher highs or lower lows, and actual order flow volume do the heavy lifting. This approach keeps their charts incredibly clean and their stops dynamic. Section 2. The institutional framework. 1 tool per category. Now that we've established that price action is king, let's see exactly how professionals actually build out their toolkit.
So, how do pros avoid creating a mess on their screens? It's all about this concept of forced simplicity. They use exactly 1 tool per category. When retail traders struggle, they'll often have, say, 3 different momentum oscillators on their screen contradicting each other. Institutions don't do that. They pick 1 tool for trend, like the 20 MA and 200 SMA. 1 for institutional value, like VWAP, 1 for momentum, usually the RSI, and 1 for volatility, like the ATR. This setup forces non-redundant information, giving you a complete picture of the market without all the noise.
Let's zoom in on that institutional value category for a moment. Volume weighted average price, or VWAP, and the volume profile are the true compasses here. VWAP isn't just some squiggly line on your chart, it's literally the execution benchmark for almost every major algorithm and trading desk in the world. And the volume profile, usually anchored or set to a fixed range, it maps exactly where actual volume was transacted, pointing right to where true liquidity and fair value reside. Okay, let's dive into this next point because it's a massive mindset shift. Even when pros use familiar tools, they use them completely differently than the retail crowd. Take moving averages. The 20 EMA, 50, and 200 SMA are absolute workhorses, sure, but they're used strictly as dynamic structure and bias filters. They are absolutely not crossover machines telling you to blindly buy or sell. The same goes for the RSI. Pros aren't hunting for classic overbought or oversold levels. Nope, they're using a 14-period RSI to spot divergence or identify market regimes, like watching for it to stay between 40 and 80 during a really strong uptrend.
Section 3. The ATR risk protocol. Surviving market noise. With our lean framework set, we're moving to the absolute apex of professional trading, how institutions actually manage risk.
If you've traded for more than a week, you know this pain. It is the most frustrating problem for any trader. You do your analysis, enter a perfectly good trade, and bam, you get wicked out by a random price spike only to watch the market go exactly where you predicted. So how on earth do the pros avoid this trap?
Well, the answer lies in a massively underused tool called the Average True Range, or ATR. This is the cornerstone of the volatility and risk category. Rather than throwing your stop at some arbitrary price level or a static percentage, the ATR mathematically ties your risk management directly to whatever the current market volatility happens to be right now.
Let's look at how this builds into an executable strategy. Instead of guessing, institutions will use a multiple of the ATR, usually 1.5 or 2 times the current value, from their entry point to set a dynamic stop distance. Doing this accounts for market noise, totally preventing you from getting prematurely stopped out by normal price fluctuations. And to make it even more robust, they refine that mathematical distance by checking higher timeframe structures, like the daily or weekly charts, ensuring the stop is safely tucked behind a highly meaningful structural level.
Section 4. Volatility-adjusted sizing, the math of survival. Knowing where to put your stop is really only half the battle. Let's see how this ties into your actual account balance.
So the crucial point here is the golden rule of institutional sizing. Your predetermined monetary risk must remain constant. If you decide you're risking 1% of your account equity on a trade, say $100, that $100 must perfectly match your ATR-based stop distance, period. Whether that stop is 10 points away or 100 points away, the actual dollar risk doesn't change.
This conversational math is literally the secret mechanism to long-term survival. Think about how this naturally adapts to the market. In high volatility environments, the ATR is high, right? That means your dynamic stop distance has to be wider to avoid the chop. To keep your total risk at that flat 1%, you naturally have to take a smaller position size. Conversely, in low volatility environments, the ATR is low, your stop is much tighter, which mathematically allows you to take a larger position size while taking on the exact same amount of risk. It transforms risk management from a fragile, static rule into a dynamic, bulletproof process.
Section 5. Pro-operational rules. Multi-time frame discipline. Finally, let's break down the operational discipline required to execute this entire framework consistently every single day.
Here is multi-time frame discipline in action. Step 1. Your trade hypothesis always comes from higher time frame structure and volume. That's what sets your bias. Step 2. You zoom into lower time frames and use those moving averages and VWAP to really refine your entry. And step 3. Only then do you toggle on the ATR to calculate your exact risk and size the trade. Notice how structure and volume are always the primary drivers? Everything else is just secondary context.
And executing all of this requires extreme visual discipline. A sophisticated approach absolutely does not mean a complicated screen. Professional traders intentionally maintain incredibly clean charts. Honestly, ask yourself right now, do you have tools covering up your actual candles? By default, pros might only keep the 20, 50, and 200 moving averages along with VWAP visible. They literally toggle tools like the ATR and the RSI on and off, keeping them totally hidden until they're strictly needed for a calculation or a divergence check.
I want to highlight a quote directly from our source material because it hits the nail right on the head. Clutter kills decision speed. When real money is on the line, you cannot afford to be paralyzed by 3 conflicting indicators. A clean, systematic chart is absolutely vital for executing trades efficiently and with total confidence.
As we wrap up this explainer, I want to leave you with a final thought to evaluate your own setup. Look at your charts today and ask yourself, are your indicators driving your decisions, or is market structure driving your dynamic risk? Making that shift is exactly how you stop trading like retail and start building a true institutional edge. Thanks for learning with us, and keep those charts clean.